Hello, and welcome to POMA Does, a podcast produced by the Pennsylvania Osteopathic Medical Association. We provide a voice for osteopathic medicine and share insights on issues important to osteopathic physicians, residents, and students, as well as those who embrace the osteopathic philosophy. POMA's mission is to promote the distinctive philosophy and practice of osteopathic medicine for our patients, our members, and the communities we serve. Thanks for tuning in.
Hello, and welcome to the Introduction for Financial Planning, prepared for the POMA Association. We've done this seminar a couple times for the POMA residents and wanted to do a recording here to kind of run through and let you guys go at your own pace and present some information today, go through a few different topics of what financial planning is, how do we get started in different things. So we do have a couple of disclosures to run through, so pop those up. We do not provide tax advice. This is more generic investment concepts. If you want specific investment advice, you have to reach out and have a specific conversation, but we want to run through some broad topics today. Your financial planning team, so with me here today is Kevin Grant. I'm Nicholas Mingle. Also here in our office is Elijah Macias. We're all certified financial planners and trained in a wide variety of investment concepts. So, Kevin, what are we going to chat about today?
Yeah, so as Nick mentioned, the goals of today, we'll run through some basic financial planning topics, investments, insurance, retirement planning. A lot of what goes on the market is out there in the news, so we'll touch on some of the hot topics and long-term investing strategies. We have some things specific to your industry and field, as Nick mentioned, we touched on in the live webinar. So we'll go through some of those, and also some common questions that we receive when we do these calls and things that you can reach out to us and we can assist in some expertise on certain areas that you run into issues with.
All right, so starting with the basics. I never want to assume what people know, but so a couple basics of what investing really is. So you may have heard these terms, they're the building blocks of a portfolio, right? So the stock market, most of us have heard of the stock market, but the idea of buying a share of a stock, you're buying a share of a company is a partial ownership. The flip side, the more conservative piece is the bond market. You're buying bonds, you're the lender in this scenario. You're taking your money, you're lending it to a company, and they are paying you back with interest. The other terms you would see are mutual funds or ETFs. It's an exchange traded fund. So, those are funds that can buy both stocks and bonds. Some of these can get a little more complex and do a wide variety of things like buffers and other more complex strategies. But at its core, the idea is that you don't have to go buy, the stocks of 500 different companies to get the S&P. You can buy one index fund. It's the idea that we want to diversify our investments across a number of different companies. In case one of those companies were to have a really bad year, the other ones are going to balance it out. So the idea that we want to diversify, well, we've got a couple other graphs talking about that concept, but these are the basic building blocks. Inside a retirement plan, you might see the term a target date fund. That's a fund with a date on it, at 2040, 2050, 2060. The idea is that fund is going to be more aggressive now when you have a longer time frame to retirement. I think we've got a slide on that too, why we can be more aggressive when we have more time.
Yeah, and actually taking a step back here in terms of the first decision you have to make is what type of account are we opening to hold these specific investments that Nick was referencing. So we have them broken out in two different categories. The first is a qualified account. So these are account types that are designed for retirement. You're getting benefits or tax deferral that allow it for growth for you to utilize in retirement and kind of recreate that income stream. So different types of accounts you might hear. Obviously the big ones, 401k or 403b. Those are employer-sponsored retirement plans where the company's setting it up. You have the ability to defer directly from your paycheck into these accounts. Sometimes there's a company match affiliated with it, and those provide the ability for deferral, out towards retirement. IRA and Roth IRA. IRA stands for individual retirement account. So very similar to the 401k side, except that it's not sponsored by an employer. This is something directly in your name, and you have the ability to make those direct investment decisions. And the other big thing is traditional versus Roth. Probably something you've heard about or seen online. Essentially, you're having the ability to elect how you want your deferrals or what you're putting in these accounts taxed. Traditional route on an IRA or 401k, you're getting the tax benefit today. You're getting the deduction off of your income. Those assets grow tax deferred, and you would owe tax at the point that you take the assets out in retirement. Roth is the opposite. You're paying the tax today, putting the funds in after tax. they're growing tax-free, and you take them out in retirement tax-free. So those are the kind of decisions that we work with our clients on to decide when one would be more favorable than another. And then finally, the other type of account is what we would call a non-qualified account. So these are account types that you're not looking for a specific retirement purpose, more so just for growth. So you'll see the individual or joint or trust, TOD, the type of accounts that would fall under the non-qualified bucket. And the taxation is different there as well. You know, capital gains tax on any growth. So in this way, you're paying taxes as you go rather than when you take the money out of these accounts. So those are the big decisions you're making initially. Decide the type of account that would best suit what you're looking for. Then you're making those investment decisions within that account structure that you had developed.
So some of those might come into play early on, though, because you've got the 401k plan or a 403b plan in a lot of hospital systems where you're putting that money away long term. But we've also got this other goal of accruing money for a down payment on a house. You know, that's where that non-qualified account would come into play, where we want to get more than just what the bank would get. But, you know, so we may be using multiple strategies and with different time horizons, so with different levels of risk.
Right.
So speaking of those different levels of risk, you know, the more time we have, our short-term goals, we don't have a lot of time to risk in the market. You know, hey, maybe the market's going to have a great year, maybe it's not. So, you know, unless you're just really super aggressive, most clients would see that, hey, if I've got that 1 year, 2 year goal, I need to be pretty conservative because the market could swing down, and if it doesn't recover in time, then I don't want to be at a loss position. So, you know, we tend to use more of cash, money markets, short-term bond funds for those types of investments. The longer that we go, you know, the more time we have to take risk. So we can start building in more stocks into a position, maybe dividend paying stocks is the more conservative side, getting into growth stocks for longer term goals. So, and why would we be able to do that?
Right. So kind of building off of that same philosophy, we're deciding what type of investments we want to have in each different bucket. You know, so we have the short-term goals, typically, as Nick mentioned, cash or short-term bonds. Working out to a medium-term investment, we want to have a little bit of both. And then long-term, those retirement assets, we're looking to be a bit more aggressive given the time frame. So we're showing a long-term average of different performances of the market. So these are rolling averages over 1, 5, 10, and 20 years for stocks, bonds, a mix of both, of 50-50 in cash assets. The big thing here is to notice the variation. So in the 1 year, you can see the best 1 year equity market was up 47%. The worst 1 year was down 39%. So big variation when we're looking at a 1 year time frame. As we start to zoom out over that 20-year time frame, you know, the worst rolling 20-year average the equity market has had is up 6%. So the idea there is to say once we have a longer runway, our assets are longer for retirement, you take some of the volatility out of it. So that provides us the ability to be a bit more aggressive, or a lot more aggressive, in the long-term assets. Whereas is the other thing that was referenced about saving up for a house. You know, you don't want to, if it's a 3 year time frame, you don't want to all put it in the equity market and we get one of those big drops that could happen in the equity market. So that's where we would lower our risk for that potential variation or volatility in the market and kind of take that out of play with less risky assets.
So if we're looking at these different asset classes, how do we know which one's going to be the best, right?
Right.
Well, nobody does. Building a proper portfolio is going to involve looking at different asset classes. We don't know which one's going to be the winner. You get these trends where over periods of time there may be a window here where, you know, the past couple of years large cap growth has done really well. Big US companies, tech companies have done really well with the idea that AI is going to transform things and lead the way. So whether that trend continues, no one truly knows, you know, but if that reverses, then those stocks are going to tend to be the worst performers. We saw that in 2023. The market corrected down and yeah, there we go. Large cap growth, you know, leading the pack for a lot of the past couple of years had a pretty rough down year. So when we see that line down the middle, that asset class portfolio, by mixing these different asset classes that are going to perform in different ways, while one's maybe lagging, the other one's going to kind of pull the portfolio ahead. So when we build portfolios, we're not concentrating in one particular area. We're spreading that risk out across different, you know, even in stocks and in the bond market too.
Right. You know, we're not trying to pick one stock or the high flyer in each area of the market. We're trying to take the volatility out of that. And this next chart kind of builds off that even more. So this is a piece by First Trust called Crisis and Events. The idea here is just to show that there's always something going on, whether it's in the United States or globally, in terms of news that's coming out that would, you know, bring fear to us as investors. And the idea is just to show that, yes, we have these blips, these things are constantly going on, but over the long term, the market we hope is going to go up, and over time it has. So we're wanting to not necessarily follow each and every little thing that could affect the market and the risk of being an investor, but just taking that long-term investment approach and knowing that things are going to happen. We're going to have the typical economic cycle that we're going to go through, but also these things each year that are going to come up. Tariffs is a big one that we're going through now, and this will be another blip on this chart, in a few years that we'll see. But
there's a big drop and then the quick recovery, right?
Right, exactly. And that recovery will come just as all these other events we've seen as well.
Immediate example, the tariffs, we had the COVID recession, just a super quick down and back up. The tariffs was a couple of weeks for the drop, and then a very quick recovery as headlines reversed. Headlines this week are, potential war in the Middle East. That's probably on that chart quite a few different times.
Exactly.
So not reacting to those, if the market's down 10% in the week, you might say, well, we should have seen it coming. It's like, well, but we didn't know. If we knew that it was going to happen, it would have been priced in already. But more of focusing on that time horizon more so than, the specific themes or what to avoid or what to target.
Right.
So kind of pivoting over away from the investing world, more towards financial planning. And this is pretty critical, especially as you're getting started coming out of residency. Hey, great, that all sounds good. We want to invest, we want to be diversified, but I don't even know where to get started. One thing that comes up a lot is the budgeting tools. A number of tools are available out there. If you're a DIY spreadsheet kind of person, you can build out. There's a ton of Excel tools available. There are other apps, YNAB, Monarch, Quicken, depending on your level of involvement. I always just say watch out for the free services. If you can't clearly see where this company is profiting, if it's free, then you are the product. Your data is linked up and shared to who knows where. So some of these tools are really cool in that they'll pull everything together. I'm sure somebody's working on an AI tool that's going to beat all of these,
Definitely.
But they can scan things and maybe be a little more secure. But, how do I know if I'm just getting started on this? I know I've got these different competing goals. How do I know if I'm on the right track?
Right. That's a big one, the competing goals thing. You get out of school, you're about to, and you're thinking ahead of, now I'm getting an income, but I have the debt that I accumulated during school. I have to maybe get my first big car. I want to start saving for retirement. I'm hearing all these great ideas, but how do I know where to start? I think that's really where the personalized financial planning comes in. Nick and I aren't able to see your exact scenarios and see what the best avenue to go is. I think that's the personal touch that, a financial planner would be able to assist with, and something we would come into play. But really just a big thing to know is to get that emergency fund in place first, I think is step one, overarching for most people. Being prepared for that emergency that may or will probably come up, whether it's something wrong with the car, you lose your job. Having that buffer there available for you helps minimize the kind of the compounding effect of potential debt. So getting that in place first is really key. You'll hear 3 to 6 months worth of expenses built up to kind of help you cover that gap. And then from there, it's really determining what your specific goals are. If, the house is really important to you, it's going to bump up on the list higher than maybe for some other people. Looking at debt, we're going to want to look at what the interest rate is that's being charged on those debts and potential ways to kind of help attack those in an efficient way as well. So I think number one is getting the kind of a map laid out of the importance or the priorities for you, and then kind of taking it and running from there.
Yeah, that emergency fund is about as generic, and that's the only thing you can really say this applies to everybody.
Right.
That's the most critical. That way, if you got the house and the heater goes out or whatever, you got that big repair bill to your car, that's the spot where having that reserved where we're not going to credit card debt at obscene rates is really kind of the thing that applies to everybody. Beyond that, it's really that personalization of what your specific goals are. You mentioned student loans. So that's a big one for most people in your situation. You've got there's some traditional standard loans, there's income-driven repayment plans. There are a lot of different programs about refinancing. Do I have a number of different loans that I need to consolidate under one rate? Can I fix it for longer term? There's a big question there about, is that right for you? So that's something that's, again, a more personal situation. And also, what's your take on debt? If you've got a lower student loan rate and markets are conservatively providing a pretty fair return, then maybe I want to pay the loans down more slowly and build up some investments on the other side. Once I pay off the loans, I can't just go back to them and ask for more money. So if I need that flexibility, maybe I do work on that for a little while and get that emergency reserve built up and maybe a little surplus there, and then we pivot down. So it's just kind of that track of mapping out what's that right window. Do you do the minimum? We can pretty basic finance math to say, well, if we put an extra this much a month towards this loan, we'll pay it off this much more quickly. So that's another one of those that's more personal for everybody.
Right. Yeah, and kind of shifting over to another big aspect of financial planning is insurance planning. Once again, another thing that's going to be very important to your specific field. The idea of insurance planning is to cover a potential loss of an income stream. So one key piece of it is life insurance. So a couple of different ways to structure life insurance, term being the first kind. So you're essentially going to go out there and buy a stated death benefit. Let's call it $1 million. You're going to have an affiliated amount of years affiliated with the insurance policy. So let's call it 20 years. You're going to have a stated premium you'll pay on a monthly or annual basis for that 20 years. And if you were to pass away within that time frame, a listed beneficiary would receive that $1 million death benefit. Typically much lower cost than the permanent product, which we'll touch on. The idea there is to cover that income earner for the family, or to cover some sort of outstanding debt potentially that's out there if you were to pass away and your income stream would stop. A lot of different ways to determine what amount of death benefit is right or proper in your scenario. But as I mentioned, you can look at it to maybe cover the mortgage that's outstanding. You can look at it to cover a certain amount of years of your income, 10 years of income to cover your spouse or kids. Really important piece of planning to get in place, as I mentioned, for those high income earners in case something was to happen unexpectedly.
And the term kind of mimics what's available on the group side. So group
Right.
being through your company, oftentimes there's a benefit offered there, and you can have, depending on your offer, usually it's a multiple of salary, 1, 2, 3 times salary, something like that. And you can buy more through that group coverage. If you are generally more healthy than the average person, you're better off going to the open market and getting coverage that you can select the length and the going through that underwriting process specifically to get a better rate and get something that sticks with you no matter where your employment is, though your insurance is not tied to your employer in that sense.
Right. And a good point about your age and health. The younger you are and the healthier you are, the less you're going to be paying the insurance company for those premiums. And the vice versa is true as well. So a lot of times it's important to get that in pretty early on in your career and kind of lock in that price over the term of the life insurance policy. Permanent's the other type, a little different structure there to where, as the name insinuates, permanent, we don't have a term affiliated with it. There's still a death benefit, but has the ability to build up some cash value component inside. Typically going to be a little bit more expensive, but some different strategies are involved in planning that goes into the permanent products, but there are a place for them in different scenarios. Another big one is disability insurance, which once again, that is very specific to this industry. It would cover some sort of event that would not allow you to be working anymore for a short or long-term period, where a disability policy would come in and help provide a piece of that income stream while you're unable to work and provide some stability to your family kind of until you get back on your feet and the ability to go back in and continue your career as well.
So there are a number of different questions that we've had. A lot of times it's around, the basic topics, what those balancing those competing goals, having a conversation, trying to sort out what your priorities are. Right. The student loan one is almost always, that comes up for pretty much everybody, so, kind of working through those really just involves a conversation, just kind of lay things out, map out what those goals are, what are the facts we have now, what are we working with. So happy to chat with you if we've got any specific questions that we can help out. Our contact information is up here. So please reach out to any of us, phone call or an email to kick off to find a time to chat.
Yeah, we wanted to just provide those questions to give some reference of things that we've come across from this organization that, as Nick mentioned, most likely applies to you. So we look forward to the opportunity of potentially talking with you further about it, and please reach out with any questions or concerns.
All right, thanks.
Thanks.
Thank you for joining us for this edition of POMA Does. Be sure to subscribe to POMA Does wherever you listen to your podcasts, and tell your friends and colleagues to tune in. Learn more about osteopathic medicine and POMA on our webpage, www.poma.org, and join the conversation on social media. We're on Facebook, Instagram, LinkedIn, Twitter, and YouTube. or email us at POMA@POMA.org. We'd love to hear from you. Join us next time for another edition of POMA Does.